Welcome to the deep dive. Today we're plunging into a world that definitely promises some incredible highs, but maybe also raises some pretty big questions.
Yeah.
Options trading.
Yeah, I mean, for a lot of people, it's that allure of big gains that pulls them in, right?
Exactly. But what's really going on behind the curtain in these, really complex markets?
Well, that's our mission today, basically, to pull back that curtain on options market makers.
These sound like important players.
Oh, absolutely critical. They're sort of the backbone of market liquidity. But their actions, they ripple through the whole financial system in, well, fascinating and sometimes pretty surprising ways.
Okay.
So we'll unpack their role, look at how they manage this immense risk through hedging, and then really get into the impact of what they do, especially, with this big surge we've seen in retail trading lately.
And to help us navigate all this, we got a really interesting mix of sources, don't we?
We do. We've got a pretty rigorous academic paper looking specifically at how these market makers hedge. Then discussions straight from places like Reddit, which kind of give you the pulse of the retail trader.
Right, the ground level view.
Exactly. And also some in-depth articles looking at recent market events involving some pretty major trading firms. So yeah, it should be a fascinating deep dive for you, the listener.
All right, let's start at the beginning then. Who are these options market makers and what's their main job?
Okay, so at their core, they're essential because they provide liquidity. Think of them as the always-ready intermediaries in the options market.
Always ready? How?
They're constantly quoting prices on both the buy side, that's the bid, and the sell side, the ask.
For
thousands of different call and put options, yeah. Across all sorts of strike prices, different expiration dates. They basically make sure that whenever you want to trade an option, there's someone there willing to take the other side. There's a market.
Okay, so if I, just a regular retail investor, decide I want to buy a call option on, say, Apple, a market maker is probably the one selling it to me.
Very often, yes. They take the opposite side of your trade, which means, they take on the obligation. If that call option you bought gets exercised, they have to deliver the Apple shares.
Right. But how do they actually make money doing that? It sounds incredibly risky. Like they're just setting themselves up to lose if the stock moves against them.
It is risky, definitely. But they make money in a couple of ways. Primarily, it's about collecting the premium. If you buy that call option and Apple's stock price doesn't go up enough or it goes down,
my option expires worthless.
Exactly. And they just keep the premium you paid. Now, they don't just do this once. They do it thousands, maybe millions of times a day across tons of different stocks. It's a volume game. They rely on making small amounts on average over a huge number of trades and then managing their overall risk very, very carefully.
Okay, that makes more sense. Volume and risk management.
Yeah.
But still, that risk seems huge.
Right.
Use the NVIDIA example earlier. If they sell a call at $500 and the stock just skyrockets to $800.
Yeah, the potential loss is theoretically unlimited or at least astronomically high.
So how do they possibly protect themselves from that kind of scenario? That's where hedging comes in, I assume.
Spot on. Hedging isn't just like a good idea for them. It's absolutely essential. It's baked into their business model. It's how they survive taking the other side of all those bets.
So how does it work? What's a common way they hedge?
Well, a really common strategy is using the underlying asset itself. So if they sell that $500 NVIDIA call option, they might, at the same time, go out and buy some NVIDIA shares. The amount they buy is calculated based on the option's delta, its sensitivity to the stock price.
So they try to offset the risk from the option by holding the stock.
Exactly. It's called delta hedging or underlying asset hedging. If the stock goes up, yes, they lose on the call they sold, but they gain on the shares they bought. It helps neutralize the position.
Okay, that makes sense. Is it just buying the stock, though? Or are there other maybe more complex ways they do it? Can they use options themselves to hedge? Kind of like fighting fire with fire?
Yeah, that's a good way to put it. They absolutely can and do. They might use other options, contracts, maybe buying a put option or creating spreads, which are combinations of different options.
Why would they do that?
To sculpt a more specific risk profile. Maybe simple delta hedging with the stock isn't perfect or it's too expensive. So they use other options to fine-tune their exposure, trying to create a position that's much closer to risk neutral across their whole book of trades. It gets pretty sophisticated.
Okay, hang on. This hedging, which they have to do.
Yeah.
You're saying it can actually ripple outwards and affect the cost of trading for everyone else, like making spreads wider? That feels backwards somehow.
It does seem counterintuitive, doesn't it? But yeah, there's this fascinating ripple effect. Market makers, you see, they constantly worry about something called adverse selection.
Adverse selection, meaning?
Meaning they're worried they might be trading against someone who knows something they don't. Someone with inside information or just better analysis about where the price is headed. So when an options market maker, an OM, goes into the stock market to place those delta hedges we talked about, buying or selling shares,
Yeah.
the market makers in the stock market see those trades coming in, and they might think, why is this big player suddenly buying or selling so much stock? Maybe they know something. It creates uncertainty, risk.
So the stock market makers get nervous.
Kind of. They perceive this increased risk, this potential information asymmetry. And how do market makers react to increased risk? They widen their bid-ask spreads. They make it a bit more expensive to trade that stock to compensate themselves for the extra danger.
And that cost gets passed on.
Directly. That wider spread in the stock market, it feeds back into the options market. The cost of hedging just went up for the options market maker, so they, in turn, widen their bid-ask spreads on the options.
Wow. So basically, the wider the spread on a stock, the wider the spread is likely to be on its options, partly because of this hedging effect.
That's a key part of it, yeah. The spread of a call option is positively related to the spread of its underlying stock.
And is there solid proof of this, like actual data?
Oh, yeah, absolutely. Academics have crunched the numbers on this extensively, using time series analysis, looking at how things change over time, and cross-sectional analysis comparing different stocks at the same time.
And what did they find?
They found really strong, consistent support for this idea. The data shows that this stock-based hedging by options market makers does lead to wider call option spreads. It's not just a theory, it's empirically validated. It impacts both the initial cost of setting up the hedge and the ongoing costs of rebalancing it as the market moves.
So it's a real cost baked into options pricing driven by this need to hedge.
Precisely. And it also kind of hints at the potential for really big leveraged moves in these markets, which actually brings us neatly to probably one of the most talked about, maybe misunderstood forces in options, gamma.
Gamma. I hear that term thrown around a lot, often called the delta of delta. What does that actually mean in plain English? Can you give us the ELI5 version first?
Okay, sure. Think of delta as the speed of an options price change compared to the stock's price change. So if a stock goes up $1, maybe the option price goes up 50 cents, the delta is 0.5.
Right, sensitivity to price.
Exactly. Now, gamma. Gamma is the acceleration. It tells you how much that speed, the delta, changes when the stock moves $1.
Okay. So it's the rate of change of the rate of change.
You got it. So if gamma is high, even a small move in the stock price can cause the options delta to change really quickly, and that means the market makers hedge. It suddenly becomes wrong, forcing them to adjust fast. That's where things can get explosive.
And you hear people talk about being long gamma or short gamma. What's the difference there? And where do most regular traders fit in versus the market makers?
Good question. So long gamma basically means your net long options. Maybe you bought a call or you bought a put.
Okay.
The cool thing about long gamma is your exposure increases when you're right. If you bought a call and the stock goes up, your delta increases, meaning you make money faster. These positions love big, trending moves.
But there's a downside.
Yeah, the downside is theta decay. Time is working against you. Every day that passes, the option loses a little bit of value just due to time running out. Most non-professional traders, probably many listening, are usually in this long gamma camp when they buy options.
Okay, so what about short gamma?
Short gamma is the opposite. Your net short options. And guess who is often short gamma?
The market makers.
Bingo. Because their customers, retail traders, institutions tend to be net buyers of options, long gamma, the market makers, taking the other side, end up net short options or short gamma.
And what's that like?
Well, shrimp gamma positions actually benefit from low volatility. They like it when the market just chops around sideways. They collect that theta decay we talked about.
Sounds good so far.
But, and this is a huge but, when the market makes a big move against them, their exposure grows dramatically in the wrong direction. If they're short calls and the stock rockets up, their negative delta gets bigger fast. They lose money faster and faster. It's like trying to hold back a wave that keeps getting stronger. Limited potential gains, but potentially massive losses if things go wrong.
And that sounds like the setup for the gamma squeeze we hear about.
Exactly. That's the mechanism right there.
So walk us through it. How does a gamma squeeze actually happen? How does it create those crazy price spikes?
Okay. So imagine market makers are heavily short gamma. Lots of people bought calls, maybe out-of-the-money calls.
Right.
Then the stock price starts to rise, maybe triggered by some news or just momentum. As it rises, the delta of those calls the market makers are short increases rapidly because of the gamma.
Meaning they're suddenly much more exposed on the short side.
Precisely. To stay delta hedged, what do they have to do?
Buy the underlying stock.
They have to buy the stock. And they have to buy more and more of it faster and faster as the price keeps rising and gamma accelerates the delta change.
So their own hedging adds to the buying pressure.
Exactly. It creates this positive feedback loop. Rising stock forces market makers to buy, which pushes the stock higher, which forces them to buy even more, and boom, you get a gamma squeeze.
And can retail traders actually make this worse or even help cause it?
Oh, they can absolutely amplify it, especially when retail traders pile into those short-dated, out-of-the-money OTM calls.
Why OTM calls specifically?
Because OTM options tend to have the highest gamma, especially as they get closer to the strike price. So when retail buys tons of these high gamma calls, it forces market makers to take on even shorter, more dangerous gamma positions, making the whole system much more sensitive to that squeeze dynamic.
Wow. Okay, so that's the regular gamma squeeze. Is there such a thing as a reverse gamma squeeze, like going downwards?
Conceptually, yes. It's the mirror image.
How would that work?
It would happen if investors were buying a lot of put options. Market makers selling those puts would become short gamma on the downside.
Okay.
Then, if the stock price starts to fall towards the strike prices of those puts, the market maker's negative delta from being short puts gets bigger. To hedge, they'd have to short more shares of the stock.
And that selling pushes the stock price down further.
Creating another feedback loop, but this time driving the price downwards. Shorting begets more shorting.
Oh, so same mechanism, just inverted. But is it as common or as easy for, say, retail traders to trigger?
Generally, no. It's harder. For one thing, most retail traders simply aren't allowed to short stocks directly.
Right, broker limitations.
Even for those who can, the margin requirements for shorting are often much higher than for buying. It's just structurally more difficult for a large group of retail traders to exert the kind of concentrated selling pressure needed to kick off and sustain a reverse gamma squeeze compared to the buying pressure for a regular one. Possible, but less likely.
Got it. This really highlights how much impact retail traders can have now, especially on the buy side. Our sources really point to a huge shift here recently. What kicked all that off?
Yeah, there was a definite inflection point. It really started around October 2019 when a lot of the major U.S. brokerages went to zero commissions.
The commission wars.
Exactly. And then right on the heels of that, you had the COVID-19 lockdowns starting in early 2020.
So people stuck at home with maybe some stimulus money and free trading.
It was a perfect storm. It led to this really substantial, unprecedented explosion in retail trading activity. Platforms like Robinhood just saw massive growth.
And was this just people buying stocks, or did it spill into options too?
Oh, it massively spilled into options. The data is pretty stark. Single stock option volume just took off, completely dwarfing the volume in index options or ETF options.
Really? By how much?
In the second quarter of 2020, single stock option volume was nearly 3 times higher than it had been the year before. It was a huge shift.
And what kind of options were they trading?
Primarily shorter dated ones. Options with less than 2 weeks until expiration became super popular. And overwhelmingly, it was call options. Call buying just dominated.
So retail wasn't really playing the downside with puts as much. It was mostly bullish bets with calls.
Overwhelmingly so. If you look at the net demand buys minus sells from retail investors since that October 2019 period, their net demand for call options more than doubled.
Wow. And what about institutions during that time?
Their demand stayed relatively flat. This surge was really driven by retail.
And we already touched on this with hedging, but just to reiterate this massive wave of retail call buying, what did it mean directly for the underlying stocks?
It meant huge buying pressure on the actual stocks. Because remember, market makers taking the other side of all those retail call buys had to delta hedge.
By buying the stock.
Right. And the sheer volume was incredible. Some estimates suggest that this market maker delta hedging, driven by retail option flow, could account for something like 30 to 40% of the total daily trading volume in those underlying stocks.
30 to 40%. That's enormous. They weren't just participating, they were almost driving the price action in some cases.
In many cases, yes. That hedging flow became a major factor in stock price movements.
Okay, so this unprecedented activity must have done some weird things to the options pricing landscape itself, right? What about this volatility surface you mentioned? Sounds complex.
It sounds complex, but the idea is simple enough. Think of implied volatility. The market